Welcome to Unlocking the Upside, the podcast that cuts through market noise and helps you make smarter investment decisions. I'm Jeff Robinson, founder of theinvestmentanalyst.com, and with me, as always, is my co-host James, ex-buy-side analyst and the voice of reason when I get carried away. James, today we're diving into something every investor deals with, but few truly understand: market miscalculations.
That's right, Jeff. We're going to break down why markets swing between euphoria and despair, how investor psychology drives prices, and most importantly, how rational investors can profit from all this volatility. Get ready for some deep insights and practical strategies.
Markets are driven by fear and greed, but what's truly mind-blowing is that 90% of trading decisions are influenced by emotion rather than logic. The psychology behind market swings is one of the most fascinating, yet least understood aspects of investing.
You know what's really interesting about that statistic? It completely challenges the traditional idea that markets are rational and efficient.
Exactly right. The field of behavioral finance has shown us that humans are basically walking bundles of cognitive biases. Loss aversion alone makes us feel twice as much pain from losses as pleasure from equivalent gains.
That explains why even experienced investors make such dramatic moves during market downturns.
Then here's what's really fascinating. So during bull markets, investors develop almost selective hearing. A study showed that during the 2021 market rally, investors ignored an average of 7 risk indicators that would have normally caused concern.
That reminds me of the dot-com bubble. Could you break down exactly what happened there? The psychology behind it is incredible.
Picture this: companies with zero earnings were reaching billion-dollar valuations simply by adding .com to their names. One famous example was Qualcomm, which saw its stock rise 2,600% in 1999 alone. That's what pure euphoria looks like in market terms.
Well, that's just mind-boggling when you think about the actual fundamentals behind those valuations.
Then here's where it gets really interesting. The same psychological patterns repeated during the 2008 financial crisis, just in reverse. High-quality companies were trading at 80% discounts to their intrinsic value because fear completely overwhelmed rational analysis.
So what triggers these massive swings in market psychology?
Often it's external catalysts that seem minor at first. Take the recent Bank of Japan situation. A 0.1% interest rate change triggered a $300 billion market movement. It wasn't about the rate itself, but how it affected investor psychology.
You know what makes this even more intense nowadays? Social media's impact on market sentiment.
Oh my goodness, yes. The GameStop saga is the perfect example. A group of retail investors on Reddit managed to drive a $4 stock to $483 in just a few weeks. That's the power of social media amplifying market psychology.
That's absolutely wild. How can individual investors protect themselves from getting caught up in these emotional waves?
Research shows that investors who follow a systematic approach outperform emotional traders by an average of 23% over time. The key is having clear rules for buying and selling based on fundamentals, not feelings.
Sounds like emotional intelligence is just as important as financial knowledge.
Even more so, actually. Studies have found that investors with high emotional intelligence scores achieve returns that are 15% higher than average. It's about recognizing patterns and maintaining discipline.
Tell me more about these patterns. What should investors watch for?
Well, market sentiment typically moves through 4 distinct phases: disbelief, belief, greed, and fear. Each phase has specific indicators. For instance, during the greed phase, margin debt typically rises by 30% or more above historical averages. And
that's fascinating how predictable these patterns are when you step back and look at them objectively.
And here's what's really powerful. Understanding these patterns creates opportunities. During the March 2020 COVID crash, investors who bought quality stocks at peak fear saw average returns of 114% within just 1 year.
Those are incredible returns, but it must take enormous discipline to buy when everyone else is panicking.
That's why having a systematic approach is crucial. Research shows that investors who use pre-committed trading rules are 76% more likely to stick to their strategy during market extremes.
How do you develop that kind of systematic approach?
It starts with understanding your own psychological biases. Studies show that simply acknowledging our biases reduces their impact by about 50%. Then you create specific rules for entry and exit points, position sizing, and risk management.
Sounds like you're essentially creating a framework to override your natural instincts.
Exactly, and the data backs this up. A fascinating study of professional traders found that those using systematic approaches achieved 42% higher returns with 67% less volatility compared to discretionary traders.
Those numbers really drive home the importance of having a system.
And here's the ultimate irony. By understanding market psychology, you can actually profit from other people's emotional mistakes. Warren Buffett made an estimated $10 billion during the 2008 crisis simply by buying when others were fearful.
That really brings it full circle. The market's psychological swings create opportunities for those who can maintain perspective.
Looking ahead, we're likely to see even more dramatic psychological swings as technology accelerates information flow and social media amplifies sentiment. The key will be maintaining that systematic approach while others get caught up in the emotional tide.
Well, this has been incredibly enlightening about how psychology drives markets and creates opportunities.
Indeed. Remember, folks, the next time you see wild market swings, take a step back and ask yourself, is this about fundamentals or is it just another turn of the psychological pendulum? Because understanding that difference is often where the biggest profits lie. But before you go, we would like to introduce you to something new.
Markets are driven by more than just fundamentals. Investor psychology plays a crucial role. Fear and greed fuel volatility, creating both risk and opportunity. To navigate this landscape successfully, finance professionals need more than just technical skills. They need a strategic approach to financial modelling. In Financial Modelling Mastery for Investment Analysts, Jeff Robinson, former UBS Managing Director and 10-time #1 ranked EMEA analyst, bridges the gap between spreadsheets and real-world investment analysis. This book goes beyond the basics, teaching readers how to build models that reflect the true complexities of businesses, anticipate market overreactions, and integrate qualitative insights with quantitative forecasting. As former Wall Street Managing Director Guy Waynes puts it, this is more than just another financial modelling guide. It's a masterclass in analytical thinking. Financial Modelling Mastery for Investment Analysts is an essential resource for those looking to gain a competitive edge in volatile markets. Get your copy today at theinvestmentanalyst.store. Take control of your investment decisions and elevate your financial modelling skills today. Get your copy of Financial Modelling Mastery for Investment Analysts at theinvestmentanalyst.com and start making smarter investment decisions.